Good afternoon, everyone, and thank you for reading through those disclosures, and welcome to another one of Avant-Garde Trading's free educational trading webinars. We are thrilled to have our guest presenter this afternoon, Keith Harwood. He is joining us to speak with us all about navigating market uncertainty using options. Super timely. Keith, are you with us?
I am. Thank you for having me, Natalie.
Oh, wonderful. Thanks for being here. We appreciate you taking the time. And thank you to everyone who is joining us live in the Zoom room for taking time out of your schedules to be with us this afternoon. Keith, I know you have a presentation ready to go, so whenever you want to pull it up and share your screen, you can get started. While you are doing that, I'll remind everyone that if you have questions during the presentation, please feel free to put them in the chat, and I'll be happy to get those to Keith to address at the end of his presentation. Keith, I can see the presentation looks good, so feel free to take it away.
Excellent. Thank you again for having me. And yeah, thanks for everybody for joining. We're going to talk about navigating market uncertainty using options, which, as you mentioned, kind of a timely thought process here. Before we get started, I have my own disclosures that I have to share with you guys. So all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. I'll give you all a moment to read through these disclosures, and then we'll get into the topic du jour. All right. For those of you that are not familiar with me, this is me. I'm Keith Harwood. I started my career in the option pits of the CBOE 20 years ago now. So I was a market maker on the floor, trading hundreds of equity options symbols. So in the pit, making markets, electronically making markets, traded through the subprime crisis. So the last real major financial crisis that we had back, in 2008, 2009. That's where I really got my firmer understanding on the options markets, the financial markets in general, and decided from that point, as markets started to recover, things moved a lot more electronic and spreads tightened up to the point where the market maker had a different general philosophy. With chaos comes opportunity to just kind of trade the spread between the bid and the ask. And many of you may be familiar with how wide those bid and ask spreads got just a couple of weeks ago when the market was in free fall mode, falling knife. Now, as things start to recover and the liquidity tightens up, some sort of level of certainty starts to resume with the market. That liquidity starts to get tighter again. And these options market makers tended to shift more towards volume over a true bias in the options market. Now, I also realized at that time that having a bias in the options market was going to be a significantly more productive use of my mental capital and my trading philosophy. And so I moved into more of a proprietary trading company, focusing on finding the edge in the marketplace, finding the mispricings, and leveraging them. Seeing that two edges were better than one, I worked through my MBA at the University of Chicago. And after I graduated, I started working with a hedge fund. And the hedge fund that I worked for was a commodity trading advisor, so CTA. And generally, commodity trading advisors, CTAs, tend to take a very hard look at technical trading indicators. So I wanted to learn more about technical trading. The firm that I worked with needed my expertise in options. And so I started pairing my options knowledge with their technical knowledge and their fundamental knowledge of these individual commodities, whether it was, oil, natural gas, corn, soybeans, sugar, whatever that commodity may be, knowing their fundamental bias and their edge on the market, and then pairing that with the options knowledge that I had would allow for that much more leveraged returns and higher potential expected value. Working there for a few years was a great source of knowledge share. And I decided that after working for people with millions and billions of dollars, that I wanted to work more on the educational side. And so I joined Option Hotline as the chief option strategist in 2018 to share my expertise in options, equities, fixed income, commodity trading, technical trading with the general public so that we could all learn how to express our trading views in a higher expected value and smarter way. So that's why we're here today, is talking about how things can be executed in the best way given current market conditions. Now, if you do have to leave early, you can always email me, keith@optionhotline.com, if you have questions, or call me directly, 312-600-8004. And be sure to keep an eye on your inbox for an email from support@optionhotline.com, because I'll be sending some free giveaways just for signing up, just for being here, and just for being a part of this webinar with me. So again, I appreciate all of you being here. If you do have questions, feel free to remember to throw those into the chat or the Q&A box, and I will try to address them as we go through. And if not, we will definitely try to address as many questions as possible at the end. And if you do have questions afterwards, you can, again, always email me. So what's going on today? Well, what we're going to talk about today is this market turmoil. I think we're all generally fairly aware of what's been happening. The market making brand new highs in February and then looking like catastrophe was going to hit in April, with tariff news, with economic concerns, with recession concerns, with inflation concerns, with thoughts about what the Fed can or can't do to try to help spur economic growth in a time where we may have inflation, et cetera. And the list goes on and on. Now, we've recovered somewhat from that, and that's part of this bottoming process that I want to talk about again today. And then I want to make sure that I address with you guys the trend trading signals that I utilize to identify when this bottoming process has, played its course and the market is going back into some sort of normalcy, because these falling knife, wild, tumultuous times do tend to be short-lived. Now, sometimes they last longer, like what we saw in the subprime crisis. But even a month or 2 months can feel like an eternity when we're dealing with what we've been experiencing over the last couple of months in the markets. So how do I really find that current market opportunity? Now, with that, I want to also change my perspective to identify opportunity, and how can I do that in the current market environment? Because there are certain market opportunities that are much more obvious when we have what we might call normalcy. What we saw for much of 2024, outside of a few blips from bad non-farm payrolls data or concerns over inflation. Along with that, utilizing options to increase that expected value and to leverage the directional trade when I see that opportunity. And so what is the options market telling us right now? Well, we'll talk about that as well. So with all of this, we've got a lot to cover. So we're just going to dive right in with that bottoming process from this market turmoil that we've seen. So the bottoming process tends to follow a few main patterns. And this is just historically what we tend to see when we've got this falling knife situation that we saw, at the beginning of April. We get extreme oversold conditions. This is where the RSI, the relative strength index, kicks in. If you're not familiar with the RSI, don't worry. I'll make sure that you guys can have a good understanding of that. But what it's really telling us when that RSI gets very low is that the down moves in the market are significantly larger than the up moves, i.e., when there are sellers, they are much more aggressive than when there are buyers. Now, when that extreme RSI kicks in, it tells me that there are more sellers than buyers, but they are just trying to get out. They're doing whatever they can to get out of their positioning. And when buyers come in, they're a little bit hesitant. And when we get way off base or off sides on an RSI being way too high, i.e., the buyers are getting too aggressive, or way too low, the liquidating sellers are getting too aggressive, it starts to tell me that we're maybe nearing the end of a falling knife situation. May not be the end, but we're nearing it. We then tend to find some consolidation in the market, i.e., we stop making new lows. We find a support level that the investor is willing to buy. So we get some consolidation, we get some more aggressive buyers, and maybe just as importantly, sellers aren't just panicking to get out anymore. They're now a little bit more selective on their liquidations. They're more selective on their pricing. There's a little bit more action in day trading, as opposed to investors just trying to get rid of the market and stop the pain. We see some positive divergences in the MACD. It's another trend following signal that I use, a technical signal, where when we start to see that divergence occurs, and I'll show you an illustration of it in the coming slides, that can be an indication that the momentum is now shifting. No more downside pressure, but now bullish behavior starting to really come into the market. And that does not happen on the lows. That happens as we start to resume our upward trend. And that kicks in with these trend reversals. We start making higher highs. We start making higher lows. No longer are we continuing that downward pressure. The market is not falling without any indication of where the market's going to go to the downside. Now, the bull is starting to get back in control. We're seeing them willing to pay higher prices. Sellers not finding lower prices to get out. They're actually getting better value as they sell out of their position and maybe start to show some signs of regret in making these higher highs or missing fear of missing out on the opportunity to the upside. And then the real big key for me is that growth stocks break out of their ranges and start showing real bullish leadership to this market. And that's where I watch tech. That's where we really see it in the growth stocks, whether it's semiconductors like NVIDIA or your traditional tech names that many of which have earnings this week: Apple, Amazon, Meta, Facebook, Microsoft. A lot of them have also been driven into AI. We're watching like Palantir. These are the types of names that start to show me that people are looking to take more risk on things that should be growing and generating their profits and need capital to do so. And those stocks that need capital to do so are in a very difficult position when the market is in free fall mode. They're finding a lack of investors. But when they find those investors, those willing to bet on their future, it means people are willing to take that risk on what the future holds instead of what is currently profitable today. And so when I see tech names, growth names rallying, that's a great sign to me that the market is starting to perceive that the risk is lower. They're willing to take that risk and they want to participate in that great upside longer term story. So speaking of tech, let's look at the NASDAQ 100. So the NASDAQ 100 chart is wild. Really, since the highs in February, on February 19th, it has been a nearly one-way driven trend to the downside. And it looked like things were starting to bottom as we got through towards the end of March. March 25th, pressing back against this red line here, which is the 200-day moving average, before ultimately collapsing further on tariff woes. And then on April 9th, we saw a dampening of the tariffs. And the market was willing to reward the bull or punish the bear with a 10% rally intraday from lows right back up to the range in March. Now, maybe that was a bit aggressive, so the market started to shop around. And now is trading back above those levels from April 9th, showing some bullish signs. Now, when I go through my checklist here, I'm seeing a lot of this getting checked off. First off, that extreme oversold condition with the RSI. Right here in the middle of the screen near the lower part is the RSI. Now, that first attempt at bottoming in mid-March showed a sub 30 RSI. That's that extreme oversold condition. First sign of potential bottom. Didn't end up working out, but the second sign, maybe things are different. We saw an extreme oversold RSI sub 30. So what's different now than last time? Well, let's just keep going through the list. Consolidation. Looks like we had some good consolidation in March. So again, signs of bottoming. This time we had some consolidation, albeit with wider ranges, with stocks stopping falling, lower highs, lower lows. We're not getting the same big whipsaws of 10% price action. Now, it looks pretty wild when I compare it to the March bottoming attempt or the normalcy of November, December, January, and that's natural. But it is smaller ranges, and that is a big key. That's what consolidation really is smaller ranges. We had the positive divergence in the MACD. We did have that again mid-late March with the black line going above the purple line. That is a sign that the buyers are getting more aggressive than the sellers and that there is a momentum shift in the market. We had it again last week. So we're seeing some of this bottoming action coming through again. And we're continuing to see it with the trend reversals, higher highs, higher lows. Well, we had higher highs and higher lows just starting to show in the market in late March, and we're starting to see it again over the last week. Higher highs and higher lows. The market is not getting back to the levels that we even saw a week ago, and we're seeing prices go back up into the range that was made in mid-March. And then finally, those growth stocks breaking out of ranges, and I'm watching tech. Well, on tech here, we haven't necessarily confirmed that yet once again. Last time it started looking positive, we got close to the 200-day moving average before failing. This time we're still below the 200-day moving average as well as the 50-day moving average in blue. which we did not breach through last time. But what about this week? We've got all these big tech earnings. If they start coming out bullish, or at least not bearish, that may give some ultimate sign of the market completing the spotting process and going back into bullish behavior. So we're not there yet, much like what we saw in March. We're not 100% of the way there. 4 steps down, 5th step is a question. Can we see these growth stocks break out of ranges? Can tech lead us forward? Now, it's going to need some more confidence in the market, but at the very least, I can start utilizing some of the tools that I use and that I've used for years to identify opportunities in individual names. And there are a bunch of individual names right now that are starting to show some of those positive trends coming in. And the first thing that I use when I'm identifying new opportunity is the moving average. Once we've started seeing this bottoming process coming through, I go through that moving average process to decide what stocks are leading us now, what stocks are bullish now, what stocks should continue to be bullish and give me a high probability of success to the upside. So I start with these simple moving averages. Now, what is a simple moving average? It is simply the average closing price over a recent period. In many cases, we look at the 10, the 20, the 50, the 100, and the 200-day simple moving average. To see where I'm at here, the purple line is the 10-day moving average. That is the average closing price over the last 10 trading days, 2 weeks. The green line is the 20-day moving average, the average closing price over roughly the last month. There's usually about 22 trading days per month. The 50-day is in blue. That is my average closing price for the last roughly 2.5 months. 100-day in yellow is the highest level right now. That's the average closing price over roughly 5 months. And then the red line, 200-day moving average, roughly the average closing price over the last 10 months. Now, why do we use 10, 20, 50, 100, and 200? Honestly, it's what people tend to use. These are big round numbers. They tend to work. They tend to be looked at. And because they tend to be looked at, they tend to be big key levels. Really above the 200-day moving average is a huge level for a lot of people because it shows long-term bullish behavior. Short-term bullish behavior is shown when we are above the 10 or the 20-day moving average. Long-term when we are above the 200-day moving average. Who's in control of this market? Short-term, the bull. Long-term, the bear. Because we are between the 10 and 20-day moving average on the low side, prices in between that, and then above us we have the 50, 100, and 200-day moving average. So we don't have the all clear yet. When we have a bullish trend, we tend to see prices above all of these key moving averages and short-term moving averages, above medium-term moving averages, above long-term moving averages. That's what we saw in October, November of last year. We saw them coming together at the beginning of March, end of February. And then we saw them start to invert as prices stayed below the 10-day moving average, drove below the long-term moving averages, and the bear started taking much more control throughout February, March, and into April. So what do I do to identify when there's a true trend appearing? I compare prices to all of these moving averages. Now, again, here we got the simple moving averages in the NASDAQ. I kind of touched on these already, but when I look for a true trend, I look for a triple moving average signal. Now, this is a little bit more complicated than just a simple moving average in that I am comparing 3 moving averages to each other and comparing the stock price to all 3 of them. When the short-term 22-day moving average is above the medium-term 48-day moving average, is above the longer-term 89-day moving average, it tends to signal a trending stock. And I like these numbers because 22 days is about a month. 48 is basically 2 months, and 89 is about 4 months of trading. So I've got 1 month, 2 month, and 4 months of trading moving averages that I can compare. And when I see the 22 above the 48, it means in the last month, we have more aggressive buyers than we have had over the last 2 months. And when that's above the 89-day moving average, we've had more aggressive buyers than over the last 4 months. Short-term momentum is in my favor, and investors are seeing opportunity. To see a simple illustration of this, I just go to Palantir. Palantir has been on a tear. It's actually up about 116 today. So on Friday, the 22-day moving average went above the 48-day moving average, giving me my triple moving average signal. Once the 22 was above the 48, was above the 89, the green above the blue, above the yellow in this chart, that was a sign that this is now a trending bull stock. Stock prices above all three is natural when we have these crossovers happen, because I need prices above these moving averages for the 22-day moving average to have an upward slope at a more aggressive rate than the 50-day or the 48-day moving average. So in this case, Palantir had been sort of questionable, still looked somewhat bullish about 2 weeks ago, but never really got that great momentum of the 22-day back above the 48-day until Friday. And like I said, we actually have appreciated by $6-7 more in Palantir to start this week as a result. So Palantir, one of the great examples here of how this signal can work. And as you look at it back in like November, prices stayed above those key moving averages and they were stacked nicely. Once we got below the 22-day moving average here in January, it was a sign of maybe some question marks. We got back above into the beginning of February, late January, early February, had bullish earnings, pushed through to new highs, but then started collapsing with the rest of the market after the market made their highs on February 19th. We got pretty high above those levels as well, which can sometimes be an overbought indicator. But that's why I use some of these other signals to determine whether we are overbought, oversold, time to reduce the long positioning, or time to continue to add. Now, I don't have a ton of time to get through a deep dive in the RSI, the MACD, the average trading range, the average true range. So I will be sending you those 5 indicators for trading success in an ebook separately. So you got to watch supportedoptionhotline.com again to receive that free ebook. You should be receiving that tomorrow, with a more detailed look at how, after that original signal triggers, like what we just saw in Palantir, how I could manage a trending trade using the MACD, the RSI, these simple moving averages, the average true range, and more indicators for how to identify and stay with the trend when it is going in your favor. But, beyond that, how can I identify opportunity when we are so choppy, so volatile, so uncertainty? Well, when that market is so muddled, so fuzzy, I have to find a strategy that can give me some clarity. And there are 2 great ways for me to do it. If I'm looking out and I'm looking through my normal eyes and things seem fuzzy, it might mean I need some glasses. Maybe I'm nearsighted, maybe I'm farsighted. Maybe I need to zoom in and look for a market range that I'm comfortable with trading by reducing my time horizon, which will naturally reduce the volatility of the market. If 2% moves every day are too much for me, well, I can look at a shorter time frame with smaller moves. And I can review those technicals with a different perspective to identify shorter term moves. Now, it may not hold for weeks or months, but if I can find something that'll hold for hours, days, maybe weeks, that can be a great way for me to trade in the short term while we're experiencing some greater volatility. Look for that money flow in the short term and know that maybe over the long term, this is not a position that I want to hold through the rest of 2025 or through the rest of my working time until I'm into retirement. Now, if I want to look more for that type of situation, my retirement type trades, I can zoom out. I can see those long-term trends that are still holding and those that are at risk. So by zooming out, I actually get a bigger picture view. It's looking at the forest through the trees. So I can see the trees at times by zooming in. I can see the whole forest by zooming out. And then I can look for that big potential tailwind for the market. So let's just give you an example here by looking at the S&P 500. When I look at the S&P 500, I'm a little bit muddled here. Yeah, we've got some of that bottoming action that I mentioned. Yeah, things are getting a little bit better, but it's not 100% clear yet. So in the short term, maybe in the medium term, things are questionable. But when I look down to an hourly chart, things start to look a little bit better. So we had that whipsaw down in April 8th, April 9th, the downward action, the April 9th rally as tariff news started to look better. little bit more consolidation. A lot of this leadership starting to come up. And now these prices on the hourly chart are above those long-term moving averages, above the 200-hour moving average, above the 10-hour moving average, above the 20-hour moving average. We're starting to see signs of increased bullishness, breaking out of ranges, getting to new highs. So in the short term, I can see some bullish price action here. And again, this is with tighter ranges. The range on my chart here now may be down to that 50 period moving average or the 100 period moving average at 524, down $23. That's a long ways away for a lot of people in the market. That's still 4%. To the upside, maybe I'm looking for 560, 570, 580. It's a heck of a lot easier to stomach than looking down to 480 and up to 615. $65, $70 ranges to trade off of, that can be a difficult time period. So if I want to trade a tighter range, I need to zoom in. And I can look at some of these shorter term charts. Now we do have a MACD divergence here that's showing maybe some signs of bearishness. It's not 100% clear yet, but at the end of the day, this is going to give me a different perspective on the market and what I can utilize for maybe an entry signal on a longer term bullish bias, or a trading opportunity saying that the market is short-term overbought, has a little bit of a bearish input. And since I've got a little bit of a fuzzy, slight bullish bias on the long run, maybe it means I need to hold off for a couple of hours until things are a little bit cleaner, a little bit better. On the alternative side, I can zoom out and say, okay, well, where's my clear support here in the market on a weekly chart? Well, with a weekly chart, we had a great long-term bullish run here for months. And we started to break down below some levels. Much like the daily chart, of course, we don't see a bullish normal trend for the market. We've gotten below some big weekly moving averages. We're starting to find some support here at this 100-week moving average, but that's a little ways below. And maybe above 570, 575, things start to look a lot cleaner to the longer term trend. On the whole, if I go back a year and a half, 2 years to June of 23, we're still well above those prices. So if I have a long time horizon and I want to look for a trade to hold for months or years, even in this time of uncertainty, I can find opportunity if I can hold these key support levels. 500 is a big key support level. That was a big number back in May of 24, a year ago. We're well above that. We've had 8% this year if I go year over year at current levels. Now, of course, 2 weeks ago, we were below that level. All this chop does sometimes lead to questions, but overall, you can see the value of investing and holding for the long term. Even in this time of tumultuous behavior, it's not like we went to levels not seen in 15 years. We went to levels not seen in a year with this pullback. So we are still showing good signs of growth in the market, and that can also give me some confidence in my bullish thesis over the long run. So when I've got short-term wildness and I've got indications on the short term of maybe some better trading opportunity, I also can have this indication to myself that over the long haul, things are still appreciating in value, and I can look for the investment thesis. And I just want to use those short-term charts to help myself time the market if that's my goal. But if I don't want to have to stare at charts for every hour of every day, maybe market timing isn't the best thing for me. So how do I trade that with maybe a less certain market timing? Well, that can either be used with market timing with options or without market timing with options. I just have to pair the option with the term of my trade thesis. When I'm looking at daily charts, I might look for options that expire in a month, 2 months, 3 months. When I'm looking at an hourly chart, I might look for options that expire in a few days or a few weeks. When I'm looking at long-term charts, I want to look for longer term options to hold those long-term trends. Now, speaking of options, of course, we can go through some of the details here. Options do have incremental risks relative to stock. They have higher commissions and fees than stock. These are leveraged contracts. And so as a result, there are increased transaction costs because every options contract represents 100 shares of stock outside of some corporate actions and things like that, stock splits, etc. But generally speaking, we're looking at options representing 100 shares of stock. There's assignment risk. If you're short options, that can be assigned, and that would convert to a stock position. That's going to have a different capital requirement, different risk profile, different margin requirements, potentially, than an options trade. So you got to keep that in mind if you are selling options. Now, today, I'm just going to talk about buying options. So assignment risk is not necessarily relevant for this particular strategy. Decay risk is. Options decay in value over time. So because these options have an expiration date, every day that passes, they are worth less. And volatility, when the market's not moving, implied volatility tends to fall. This is the expected future movement in a stock. When stocks are moving, implied volatility tends to rise, and this can increase the value of an option even though time is passing. This is constantly changing, constantly needs to be evaluated, where like decay, it's just a set amount every day that options do decay. Volatility can go up or down, increasing or decreasing the value of an options position. There are other risks to consider, but these are some key risk factors for what we're going to cover today. So why do I use options? This is the simple stock portfolio trade. I could buy 100 shares of $100 stock, and it's going to cost me $10,000. So I could put 10 grand into the market in $100 stock. And if it goes to $120, think Palantir here, basically went from 100 to almost 120. I have 20% upside. If I hold it forever, I have unlimited upside because I never have a cap to my upside until I sell my stock. On the downside, let's say in Palantir, I wanted to be out if the stock went below 90 and I was risking $1,000 a share, or sorry, $10 a share, $1,000 on 100 shares. So that's my defined risk. But if we have a market collapse, or an earnings announcement that comes in bearish, I might gap below my stop level and actually lose more than that. So technically, I am risking every dollar that I put into the market if something really terrible happens. Now, I can try to define that risk by saying I will sell at 90, but if I wake up tomorrow morning and Palantir is trading 80, I can't sell at 90 if it's trading at 80. I got to go to the market price. So I can lose more than my defined stop loss if I can't execute at the price I desired. But with options, I can define that stop and execute there by not exercising my option. So call options give me the right, but not the obligation to buy the stock for my strike price on or before my expiration date. And that's the key, is I don't have the obligation. Futures, I have the obligation. Stock, I already own it. In an option, I don't have to exercise it. So if I buy a $100 strike price call, which gives me the right but not the obligation to buy the stock for $100 a share anytime in, say, the next month, if the stock's trading 94, I don't exercise. I'd rather pay $94 at market than pay $100 by exercising my call option. And if the stock's trading $120 a share, I'd certainly like to exercise my call option because I can buy the stock for $100 when it's trading $120 per share. Because I have that option, these have a premium. So in this hypothetical example, I'm saying that these options could be worth something like $5. Now it's $5 per share. And each call option represents 100 shares. So that means I have to put $500 into the market in order to have this option. That means that if I want to risk $1,000, I can buy 2 call options. Now I have control over 200 shares of stock, and now I have increased upside leverage if the stock rallies the way I'm expecting. And I have defined risk to the downside by not exercising my option if the stock falls. If the stock goes to 80, I'm still only losing the $1,000 I put into buying the call options. Stock goes to 120. Now each of these call options is worth at least $20. And so with 2 of them, I've got $4,000 of option premium minus my initial $1,000 invested, a profit of $3,000. In comparison, this is increased return and the same risk. But it's worse if the stock stays range bound. This is why I want to identify trending stocks. This is why I want to identify stocks that are moving more than the options market is pricing in. Above $110 a share, the call options are better. Below $90 a share, the call options are less bad. Between 90 and 110, stock actually performs better for my next month. Now, if I'm using a shorter time horizon on my options trade and my technical trade, and I'm looking at hourly charts, I may not look for calls that expire in 1 month, as I mentioned. I may look for calls that expire in 1 week or 2 weeks. With the increased range that we've seen, that actually might be the option that's trading for $5 per contract instead of ones that expire in a month. If I'm looking in the long-term horizon, I'm not looking for call options that expire in a month. I might look for call options that expire in 5 months, 6 months. Now, those are going to trade more expensive than the options expiring in a month. If I have more time, I have to pay more premium. But the general thought process remains the same. I can put $1,000 of my cash into that options trade instead of $10,000 into stock, and I know my $9,000 in cash is safe or can be used to diversify into other trades to leverage my portfolio. This is the joy of options. I can have 10 positions all on the bull side, and yeah, if the market doesn't move, I'm going to lose 100% of my account. But if the market goes up, I'm going to have multiple returns relative to the stock performance. So in current market environment, do I want to be long $10,000 worth of calls and risk 100% of my account? Absolutely not. Do I ever want to risk 100% of my account? Absolutely not, because I need to define my risk in such a way that I can always continue trading the next day. If I have a drawdown, if the market falls, I want to be able to take advantage of the opportunity that's there. And if I'm fully invested, I can't do that. So I do like to have some cash, and that is an important note here. Everybody's different on it. Talk to your financial advisor about what cash level is appropriate if you're trading options. But it is good to generally understand the risk and know that if buying call options and the market doesn't move, then you can actually experience a full loss instead of a stock position where the market doesn't move and you still have your full capital at your disposal once you sell out that stock for a break even. Now, when we value an option, the most well-known option price is the Black-Scholes pricing model is the Black-Scholes model. It's got 5 inputs. So we know the underlying price of the market. We know the strike price. It's given by the market, but selected by us to know where we want to have the right, but not the obligation to buy the stock. Time to expiration, again, given by the market, but selected by me. I can choose options that expire in 1 month. I can choose options that expire in 6 months, but that doesn't change. The expiration date stays the same. Time to expiration goes down by a day every day, but the date that I have the option until doesn't change unless I change my contract selection. The risk-free interest rates given by the market, and it does have some fluctuations based upon Fed projections, but that's broadly not a huge input to the market relative to implied volatility, which is estimated by the trader. Now, what is implied volatility? Well, it's the expected future movement. And the VIX is an indication of what the current market is expecting for the future S&P 500 movement. It's referred to as the fear index because it goes up when markets are panicking and it goes down when the markets are greedy. Now, sometimes it goes up a little bit when the markets are greedy, but not in the same way as what we saw in April when the market was going down. The VIX went crazy when the market was falling because people wanted to go buy insurance. And that's effectively what options are. Put options are initially intended as insurance against long stock portfolios. Now, the realized volatility is what we have seen recently, what we see on those technical charts, those wild 10% days like April 9th, that's realized volatility. Implied volatility is what we expect in the future. And realized volatility does not guarantee future volatility, although it does have a relationship. So when we have a 10% move in one day, we do tend to see larger ranges in the coming days, weeks, months. Maybe not the 10% kind of level, but certainly not the 0.5% that we got used to seeing when the market was just drifting higher a little bit every day. And we do see, and when we see those tight market ranges, we often see low, tight market ranges until a fundamental input derails it. Because a market that's not moving tends to get increased liquidity. People tend to trade larger size and tighter ranges when the market's not moving. And when the market is moving, people are a little bit gun shy and they reduce their size and widen the range. So there's a natural correlation between realized and future volatility, except when you've got a fundamental input like earnings. Stock can move 20% on earnings and then tighten up to a range because now it's now being digested, and people are then making their projections for the next 3 months, for the next quarter, until the next earnings input comes in. Tariff news constantly seems to be shifting, so we don't have that known to digest yet. It's still unknown, and that leads to increased fear, widening of ranges, lessening of liquidity, even though it's much, much tighter than what we saw just 2 weeks ago. And this is the VIX for you. Normally, bull market, we're sitting with the VIX around, low mid-teens, 13, 14%. Now, that's effectively saying that the VIX divided by 16 is your expected daily move, up or down, random walk behavior. We should stay, when the VIX is 16, we should stay within 1% of current prices more often than not. Well, the VIX got to 60 on April 8th. So expected moves were 4% per day. 4% is a big move for the market on any given day. To see that over the course of the next 30 days, 4% each day, it's pretty extreme. But there was panic. People weren't sure how much lower we could go. Then we went up 10%. So the VIX was right. The VIX was underpriced technically for that day. But then as we start to pair out the next 30 days, the next month of trading data, we start to realize that, realistically, the VIX isn't going to stay at 60 for the long haul, given current fundamental inputs and given current ranges. So the VIX is now back down to about 24%. Still elevated relative to the bull market norm of 16, 15, 14, 13%, but not nearly so much as what we saw just a few weeks ago. The market is pricing in an expectation of 1.5% move in random walk behavior over the coming 30 days. 1.5%. That's with earnings cycle coming up right now. That's with tariffs still not 100% resolved. That's with Fed not 100% resolved. It's not with full economic data information on whether or not our economy is growing at the rate we got accustomed to. So the market is saying to us right now that things are going to calm down and things can be a bit more normal, but maybe not all the way there. Now, when we look at the VIX term structure, this tells us how much we expect this movement to last. So when I look out on the cash VIX, the next 30 days, the VIX is around 27%, or was on Friday. Now, again, down towards 24%. Over the long haul, out a year, or almost a year, 9 months, I suppose now, the VIX is 22.4%. So the market's telling me right now that even with this recovery and things calming down some, we're still expecting larger than normal movement. When the market gets wild, the short-term options tend to get more expensive. The elevated implied volatility tends to be higher in the short term than in the long term. But in this case, it is fairly close to a flat term structure given current levels. For some perspective, when the market was at highs, the long-term VIX was at just under 20%. And the short term was at 16%. Because people tend to like longer term contracts. Whole life insurance is better than term life insurance because I don't know if something's going to go wrong in the next week or the next month, but something may go wrong in the next year. So I want that longer time horizon with my options insurance contract. And the short-term stuff at 15, 16%, that's trading at a discount because right now things weren't bad. Things weren't going south. And then what we saw on April 8th when the market was at lows, the VIX up to 52, the short-term options up to 40, but those long-term options stayed around 22.5%. So on April 8th, 1 year out options or 250-day expiration options were 22.7%. 2.5 weeks later, they're 22.5%. So for the long haul, the market's not 100% sure. On the short term, things have calmed down. On the long haul, there's still uncertainty. The inputs right now from the market are telling me that this volatility isn't over for 2025. It's telling me that this volatility is expected to be significantly reduced for the next month, maybe two, but we're not out of the woods yet. So when I start to see the long-term implied volatility get back down towards levels around 21, 20, 19%, it tells me that the market is much more comfortable with the long-term, just stable growth of the market. Instead, what I'm seeing is that short-term, we're expecting a reduction in the movement, maybe no new lows, but over the next year, things aren't clear. So it goes back to my technical charts. The weekly markets or the weekly chart still looks a little questionable, but there are support levels. The short-term charts are starting to look bullish, and that's what they're pricing into the options. In the medium term, that's still questionable. I can't say for sure that the long-term trend for the broad market is there, so I need to trade off of my individual stock, technical signals, and look for a time to expiration that gives me a combination of leverage and defined risk. Because I don't know that I want to buy options expiring in a year if the downside to that implied volatility, which will reduce the value of those options, is significantly more than the downside to implied volatility in short-term options. If the long-term options are going to drop 3% and the shorter-term options are going to drop 4%, because of the amount of time to expiration, the short-term options actually get hit less in a dollar or a percentage term. So I'm thinking, based upon all of this, as long as I can identify my opportunities based upon my trend following signals, the triple moving average, I like being involved in options expiring in 3, 4, 5 months. Right in this window here. They're not excessively overpriced relative to the long term. They're not excessively cheap relative to what they were on the lows, but they're at least not still at the levels that we were at on the lows, and not and I have time to make it work if we do start to just drift up and continue to find signals that the bottom is in, and that leadership from tech and growth. So on a trend trade, I simplified a stock replacement, and this fits with my thesis. So now might be the right time for it. It seems that it's going that direction. 3 to 5 months to expiration, using some discretion to try to optimize that potential return from my term structure analysis and my volatility analysis. I use an in-the-money call. So this gives me more like a stock replacement philosophy instead of purely a leveraged out of the money call. 60 to 80 delta. So in a $100 stock, maybe that's trading around the 95, 92, $90 strike, not the 60 strike, not the 100 strike, something just below current prices. And again, I'm using some discretion to try to optimize my potential return from my overall volatility analysis and giving myself time for the market to provide a tailwind for the market or for the individual names based upon that 3 to 5 months to expiration. And it's as simple as that. Do a full evaluation of the whole market, evaluate what the short-term signals are giving me, evaluate what the long-term weekly charts are giving me, and then find those names, those diamonds in the rough in a somewhat choppy daily chart that look like they have that potential to give me a good long-term growth with some leverage, and most importantly, in times that are uncertain like this, defined risk. So with that, any questions that are here, please throw those into the chat. Please let me know. If you do have questions after the fact, you can always contact me directly at email, keith@optionhotline.com, or call me 312-600-8004. And again, keep an eye out for support@optionhotline.com to receive those free giveaways, including the 5 indicators for success that I mentioned earlier, for a fuller conversation of some of the technical indicators that I use.
Thank you so much, Keith, and thank you everyone for your attention during that amazing presentation. I want to leave Keith's contact info up on the screen just for another minute so you can all write that down and reach out, as we have bumped right up against our time frame here. So write down the email, the number, and reach out to Keith or his group for any follow-up questions that you might have on his presentation. With that, I'm going to go ahead and take screen control just for a moment so we can wrap up here. Keith, thank you again for taking the time to put that presentation on. You know, you brought up a lot of really good points, and especially I think there's a lot for our viewers to go back over and think about, you know, look at those, you know, different moving averages and compare and do the analysis and figure out what's going to work best for them, especially during this particular time in the market. So it was great to have you on here and go through that. We do really appreciate it. And thank you everyone who took the time to join us live this afternoon. I know you all had busy lives and things going on, so we do appreciate you making the most of it and joining us. We do appreciate that. So with that said, we're going to wrap up here. Please feel free to join us at our next webinar coming up at the end of May. In the meantime, we'll see you back at another one of our webinars. Keith, we'll have you back soon. Thanks, everyone.